Welcome back to another weekly market and financial update. It is May 21st, 2024, and we are in the midst of Q2 earnings season. And wow, there's been a lot of data coming out. So let's take the time to unpack it a little bit. So the trend has continued, right? US companies have done really, really well compared to what their analysts have expected. Just about 2/3 of all companies that have reported so far, we're pretty much through at this point. The only really major notable company that has yet to report is Nvidia, and Nvidia is due to report tomorrow. We'll talk about Nvidia in just a second. But about 2/3 of all US companies that have reported have actually beat or met their analyst expectations. So again, very good, strong sign for the US economy, especially for large cap stocks and large cap companies, right? So speaking to Nvidia a little bit, Nvidia is set to report tomorrow, and Nvidia is a huge chip maker, right? We all know it has a very heavy weight on the market, but I think whether or not Nvidia reports well, not so well, sort of in the middle, I don't think it will have a big impact on markets overall. And the reason for that is because so many other companies have already reported. So most folks tend to think big names with big market trends and big market shifts, and for the most part, that is true, but I think because the market has done so well so far, that Nvidia will have maybe just a small impact or a very negligible impact to the stock market after it reports tomorrow. So, speaking on the economy a little bit, because I just said the US economy is doing well, and I think some of you watching might say, well, Ben, I may not necessarily feel that way, or I am still reading across the news that the news is saying the economy is not doing so hot. And really, again, that ties back to inflation. And I think the reason why inflation, or one of the major reasons why inflation has stuck around as long as it has, and the Fed has had such a hard time really tackling inflation, is due to homeowners. Homeowners, during the pandemic or shortly after the pandemic began, is when a lot interest rates were very, very low. So about a third of all homeowners across the United States, I mean, this is millions and millions of people, decided to refinance their mortgage, and justifiably so, right? A lot of us can talk to our friends and family that may own a home and say, hey, what's your interest rate? And a lot of folks will tell us, oh, my interest rate is 2.3%, 2.4%, maybe even as low as like 2.125%. I mean, these are incredibly low mortgage rates. And that's because so many folks were able to refinance during the pandemic times when interest rates were very, very low, right? So consumers and homeowners have significantly more spending power because their mortgage payments are so much lower. I mean, you try to buy a house today with a new mortgage and rates are right around 7%. I mean, that is a big difference, right? Think $1 million mortgage, right? That's about $70,000 a year in just interest versus 2.5%. That's $25,000 a year in interest, right? Not saying everyone has $1 million mortgage, but just the clear comparison, right? I mean, that's a $55,000 difference from 7% to 2.5% on $1 million loan. I mean, that is a tremendous amount of spending power. I mean, it's almost $5,000 a month extra in someone's pocket to be able to drip back into the economy every year on whatever they choose to spend it on, right? On the contrast, if you don't own a home, you might say, Ben, I'm renting and my rent has gone up, and you're right. I think renters have really been hit hard. The average national increase is about 20%, mostly in bigger cities. I live very close to New York City, so anyone that I know is renting has definitely complained about their rents going up. Again, it's about a 20% increase around major cities such as New York City, Chicago, Atlanta, San Francisco, really across the country overall, but especially in those big cities. So again, I think renters might say, well, Ben, I really don't have that same spending power, but the homeowners will tell you that yes, they do in fact have significantly more spending power. And even if they did refinance, a lot of homeowners also refinanced and took cash outs of equity, right? So it was almost like a hybrid refinance where they took money out of their home from the equity of their home values increasing. Home values have skyrocketed since really the pandemic, and ever since they really haven't stopped going up in price, right? So the combination of those two factors has really put the Fed and a lot of other policymakers in somewhat of a pickle because they are trying to keep interest rates or reduce interest rates and get them back down, but the U.S. Consumer is spending too much money and thus keeping prices high. So it's definitely a bit of a balancing act, I think, between the numbers that U.S. companies are reporting being very, very strong and U.S. spending power being very, very strong amongst consumers has really delayed the fact that the Fed has not been able to lower rates. I think that will change as the year progresses, right? I mean, people now are really definitely feeling the effects of the higher for longer interest rate policy that the Fed has implemented. But for now, we're definitely seeing that delayed landing of the economy that people thought might have happened already. But I personally think it'll be toward the end of this year. So thank you so much for tuning in this week. I know we talked about a couple of different segments, so just remember that U.S. companies are looking strong and healthy. The U.S. homeowner, for the most part, is looking strong and healthy. Renters, you definitely have something to complain about, and I hear you there. So make sure that your numbers are aligned, your savings plans are in place, managing your expectations. And again, thank you so much for tuning in, and have a very happy, healthy, and safe Memorial Day weekend. Stay warm, have fun. See you next week.